Price Headley here. Glad to be with you. It's always a lot of fun to do these events in the Trading Pub, and it looks like a great lineup today. I want to start off first, make sure I'm coming in loud and clear. If you could just type in what your favorite trading tool is, whether you're using futures, options, ETFs, stocks, or some other form of trading vehicle, Forex, you name it. So good, we're coming in loud and clear. Tommy trading the futures, ETFs, options. Okay, so we've got a mix of folks in with us, and a big part of what I wanted to share with you is I tend to focus on options, but I do believe you've got to get the underlying stock or vehicle right that you're trading. And so I'm going to lay the groundwork here for you of how I first define the right vehicles to trade. From there, you can really create some really simple option strategies around that as it relates to how I like to trade the big trends way. So let's go ahead and get started. My favorite number one indicator, of course, everything we talk about here in these sessions is geared for your information and education only. The bottom line is, you're responsible for your investment results, and our job is to get you a little more clear way that you can trade the markets. Now, I've created indicators, I've studied a lot of indicators, and what I find is that the one indicator I keep coming back to time and again, when it really focuses on something that's simple, that's easy to follow, but that I use in a very different way than what was intended actually, is an indicator a guy named Larry Williams developed called %R, which stands for percent range. And essentially what this is it's a way to track the overall range of the markets, but what I find is it becomes a very good trend indicator when it does something unusual. I'm going to share with you both Larry's original structure of the indicator and then how we've tweaked it the big trends way. Now, Larry originally started using a short-term setting of, depending on which book you look at, 10 or 14 bars, and he was looking at a scale from a high of 0 to a low of minus 100. And he was really looking at this as an oscillator, saying, well, gee, if it's in the top end of that range, thus the term percent range, if you're at 0, you're going to be on the Williams scale at the absolute peak of the range. And at minus 100, you're going to be at the absolute low point of the range, looking back over the last however many bars you look at. And so what you see is that any indicator you trade, you're going to see that you essentially are trading a belief system on the markets. You're trading what you view as the likely upside or downside potential, and this is a reversal-based indicator, okay? So most people are looking at that and saying, okay, they're looking for reversals with the belief here that stocks will not stay oversold or overbought for an extended period of time. Now, I tend to have a different belief than that. So my belief on the big trend side of things is that actually we can see trends. And so what I did, and I'm going to actually give you my setting here that I use, is I use a longer setting that's actually a 30-bar setting. So I usually don't just give that away, but bottom line is I want to get you started understanding how you can focus on a better way to trade. Now, what I use a scale from 0 to 100%. So here what I'm looking at now is a positive scale, 0 to 100%. The line is still the same, but it's, like I said, with a 30-bar setting here. So we're going to use the 30-bar setting, okay? And what we're going to do is we're going to say, okay, overbought is in the top 20% of readings, above the 80th percentile. Now, what that means essentially is if I told you we were at the 100th percentile, we are closing at the top of the range for the last 30 bars of trading. This can be applied whether you trade intraday, swing trade, position trade, or even longer term invest. You can apply it to any type of time frame. I'll even show you an example I use on a multiple time frame. And so I'll look at the 80 and 20 levels to really signal a trending security across those vehicles. Now the 50 line is also useful. I'm not going to focus on that as much today because I really want to find strong trends. But you can define a general trend by determining, are you above the midpoint 50 level or below it? That'll help you as well. And this is one single line. And the point here is that trends occur because these stocks and vehicles can remain oversold in a bear trend and a bull trend for a long period of time. So we're going to focus on some examples of that today. So first example I pulled up here was just of the S&P 500 SPY ETF daily. I've got the futures in here later. I've got some stocks in here as well. Now, the bottom line is, even have gold in here. The bottom line is that what you can see with this pattern is that when we're above the 80th percentile, which you can see over here on the right, this is pulled off a TradeStation. You can use this on a variety of platforms, so it's not platform dependent, something you can go plot yourself. Even if you're using the old 0 to minus 100 scale, you'll still see this line when you change it to a 30-bar setting. And this is just kind of my kickstart first rule. I've got a variety of rules, but let's just get you started today with the first rule, which is that if you break above this 80th percentile line, like we did on the S&P at the end of last year, literally just right around the Christmas time last year, we broke out above that 80th percentile. What I do is I'll track that through and I'll say, okay, then what happens around that peak high there? If we hold that high, then it's just the top of the trading range. That's not the start of a new potential trend. But you see what happened here is we got a buy signal because S&P kept going up. So it wasn't actually stopping at what should be the top of that trading range. You can see sometimes where we do stop, like back off of this peak around mid-June. So that was the top of the trading range. So we would not get any signal there. I'll put an X by that one. It's just the top of the range. Compared to when you follow through, we're getting a buy signal here at the end of 2011 because it's saying this is going into one of those unusual trend modes here, and that's telling us that actually we've got a market that can really trend. What you'll find as an options buyer, even if you like to sell options, you'll find that you can really get some great meaningful trend moves. In fact, what you see on that particular indicator is it stayed overbought with just a couple of points that I call retests as you come back down just underneath this 80 level. We had a kind of a slam down actually right there in early March that was a key test point, and we don't get out of the trade if it comes back under 80. We say that just resets your stop. So each of these points here essentially reset a stop. Say if it closes underneath there going forward, then you get out. You can see that this particular trailing stop approach kept you in the market all the way until the beginning of April. And once it broke that, it said now it's time to hop out of that market here in early April. You can see the market chopped around for about a month. And then it actually went the other way. It went to the downside. So then we moved down below that bottom 20%. And so the bottom line is that, you know, it's a constant process of teaching yourself how to take advantage of this. Well, you can see more recently, we had a couple of whipsaw buy signals actually. And, you know, this is not a perfect indicator. You will get occasionally knocked out for small losses. But the bottom line is that, look, especially if you use what I call the retest method, you'll keep your risk down, and then if it doesn't hold that particular strategy, you'll hop right back out. So if you get into a trade and then boom, it pops you out underneath that key low, you're going to take a small loss there. But especially when we're using vehicles like options for leverage, what we want to do is see that opportunity to find this low-risk entry point like the S&P had back here, for example, in late August a couple of times here, right before we took off ahead of Bernanke's QE Infinity plan in mid-September and caught this big, quick rally here. Even for that short pop, gave you an opportunity to get a great entry point into that trade. Now, of course, you can see this last retest actually is going to violate here. We're going to hop out of this market here in late September, and look at what's happened. We've been shopping around here for a couple of weeks, and now we've just gone on to a bearish signal here, as you see it happening right here a couple days ago. We just went bearish on the S&P. So the bottom line here is that we're really focused on, okay, how do we, you know, take advantage of these type of opportunities, the big trends way? Well, one of the first rules that I call this is bull confirmation. Looking for it to go, quote unquote, overbought above the 80th percentile, followed by then what happens after that bar's high. If it closes above that key high in a future bar, that's the kind of action point for this bullish signal. So from this perspective, we're going to really look for these type of opportunities and give us the best of the best bull trends. Now, there's a lot of times where you get at what I call the setup point, and it's not going to actually end up confirming. In those cases, you don't take a trade. You basically say, I'll pass until it shows me the right kind of a pattern. So this initial breakout point is the kind of the kickoff of bullish trends, and then, you know, when we get that initial setup bar, you'll see sometimes where the setup bar does not then get confirmed. It just tries and fails, and that'll keep you out of some of the fake out signals and allow you to focus on the truer breakout signals. So, for example, on the 6th, this is an hourly chart now for the E-mini December S&P 500 E-mini contract, and you can see going back here over the last week's worth of action, it's been a pretty volatile market on the downside over the last few days. But last week we had a nice little pop up here into the overbought territory, and then you see what happened. It confirmed there just a few bars later, and we were then saying, okay, it's time to get bullish here for a run to the upside. Now, if you miss that first move up, the retest is your way back onto a meaningful trend. So you see what happens here. We get the retest coming right back into this little pullback here. That's key support right there. That means you can actually buy there as well. Stop, and you see what happens. It'll turn on a good trade, and you'll get a nice pop in your favor, and then it'll tell you when the last one violates here, it'll tell you when to hop out of that particular trend and book your profits. Now, the bottom line is, people always ask me, how do I know that it's going to hold there? And my answer is, I don't. But what I know is, if it doesn't hold based on the chart structure, I can get out very quickly at very limited risk. And if it does hold, I get a great low-risk entry point. You can see when it tries to go above there and fails, you'll get an attempt and you will not get a follow-through. That'll keep you out of the top of a range, kind of a choppy market. You can see, of course, we've had some nice bear signals as well, where we set up, then we break down underneath these lows, and then that's telling us, watch out below, we're headed down as a short signal, and that actually leads to a very dramatic short back there here. Last Friday, actually, is when that was kicking in. You can see we've had a couple other little quick drops, I should say, with no actual confirmation. We even saw the rally this morning try to break out above this resistance here, failed, came back down, kept you signal because it didn't follow through, and then went from there. The yellow line is just a trailing 10-bar exponential average, just another way you could compare a trailing stop with the 10-bar. I find that that's a little noisier than just following the percent R all the way through. So that's the basic premise there. Now, for these bear confirmations, we want it to go in the bottom 20% of readings. This seems very counterintuitive, doesn't it? It seems like, hey, why would I want to actually short something that's already quote-unquote oversold? And the principle is because, remember, it's called the percent range. In a downtrend, the range keeps expanding lower and lower and lower as something makes new lows, right? If it was stuck in a flat range, obviously you wouldn't see that opportunity. But because of the transition from trading range to trend, you get great opportunities here. And so that what I look for is the close underneath that bar's low going forward is what, if we can follow through further to the downside, it tells me we're starting to expand that downside range, and that's starting to set us up for some more opportunity on the downside. So that's your initial breakdown point where that bear can start to growl, and the bottom line is that if we get the setup into oversold and it doesn't follow through, that's just the bottom of the trading range. I don't try to trade the trading ranges. I try to trade the more meaningful trends. So gold, another good example. Gold's been a good one for us in both directions here over the last couple of years, really, but in particular on the upside. You can see, of course, if you get that first breakout signal back on this chart, on a pretty big shot up, and then it follows through, there's your first buy signal. But really the lower risk point here is as it comes just back underneath that retest line here, there's a great retest. Oh, by the way, look at where it's retesting, right back at the prior resistance. Now that old resistance, of course, becomes new support. You get a great low risk entry here for a quick pop to the upside as it snaps on up. We've got bands on this chart as well. These are Bollinger bands in blue, longer-term Bollingers, plus acceleration bands in red. Got a 200-day moving average here in that kind of gray colored line. But you can see the really great opportunity here is where we blast off to the upside after one quick stop out, actually. So you get a quick loss, then you get on to another big breakout on GLD around 157 to 158, and it blasts off up here into the mid-170s. You can see more recently we had the setup bar, I should say the retest bar, testing about 170, and it broke down here at about 169. Now we're actually in a short-term bear mode because we've gone into the bottom 20% of readings and then broken that low here. So waiting for a retest. It's bouncing a little bit here, but waiting for that retest back above the 20th percentile. That sets up our key level to watch. So these become really easy to follow on any stock or any market you trade, whether it's futures, stocks, ETFs, Forex, you name it. Of course, Apple, AAPL, you know all about Apple. We're all reading about it now, about the success stories. But the reality is, Percent of Har will tell you when it's happening live, not after the fact. And you see the breakout that Apple had right around 400 at the start of the year. Look at how long it stayed overbought here through that entire first quarter of this year. This is the daily chart. We had a couple of retests right before the earnings gap up. We had another retest coming in right there in mid-February, right around Valentine's Day. It held that on a closing basis. Then the last retest here you can see is going to violate and take you out down here around 580 from the buy at 400. So you picked up about 45% on the stock over the course of about a 3.5-month period. That's pretty powerful. And again, it was on one of the biggest stocks on the board. Very impressive. You can see we picked up a couple other nice moves, including this last one here before the iPhone 5 launch. Notice the takeoff point, then you get the breakout happening here, and then a couple of retests. And then look at what happens. Look at where the top was on Apple. You can see we were out of that trade here. It tried to give one more buy that didn't work right around the time of the iPhone 5 launch. The iPhone 5 officially came to the public September 21st. This is a classic buy the rumor, sell the news type of an example. Truly available and everybody was aware of it. Was it a good time to buy the stock? No, it turned out to be the exact day that the stock topped, and it's been headed down since. We've had a couple of little quick short signals here. This still on an active short signal now, even with Apple coming into earnings after the close today. Does that mean you should go and buy put options on Apple? I'm not a big believer that you want to buy options right in front of earnings because you tend to pay up for those earnings. I would rather see you focus on catching the retest within a proven trend. Let's see what Apple does after the earnings report. If it bounces, what's going to happen is you should get a retest into a bounce, and so even quote-unquote good news could actually end up being sold into after a first but right now it's on an active bear signal, so I'm not recommending anything bullish for the stock. I'm saying that it's time to still be cautious, even though it's holding its 200-day moving average, which is here about 586. Now, multiple time frame analysis is another thing that I'm a big believer in. So what I want to focus on here is, okay, how do I impact all of the key time frames together? So Nelson asks, what do I mean by 30 bars? Is this the indicator setting? He says, or the number of bars per candle. This is the indicator setting, Nelson. And so what I have here on this particular chart, it's a little bit probably harder to read because I've got 3 time frames sort of squeezed into one chart view here. But this is what I look at all day, every day across my various key stocks, ETFs. And also I look at this even for option charts. So if you're an options trader, I'm a big believer that you should be looking at how your option is trending, not just your stock. I'm going to talk about options here and a couple of key principles here in a minute for how you want to trade options once you define these stocks and vehicles to trade. So here's the E-mini again. Now what I've done is I've got the daily chart over here on the right, I've got the hourly chart in the middle, and I've got the 15-minute chart over here on the left. So what you can see happening right now as we speak is that the E-mini has basically shown that we bounced this morning, but we've kind of broken back down, rolled back over here intraday, and we're starting to roll over some more. So basically we were getting an active sell signal on the 15-minute chart here. Oops, lost that. Let me see if I can turn that off. Sorry about that. And let's see if I can clear that real quick. Bottom line is that let's clear that page. There we go. Now let's try again. What we're looking at here is that clearly, we're looking for an opportunity to say, okay, how can we focus ourselves? Let's just do the laser pointer here for a second, see if that helps. What we're looking at is that we're breaking down into the oversold territory on the 15-minute, right as the daily chart is actually over here on the right has broken down and then confirmed here just a couple of days ago. You can see we've been in pretty bullish uptrends for the S&P. We'd had a couple of nice retests into here and then a snap back up here into the Bernanke-inspired easing there in mid-September. Then we broke down, we violated, now we chopped around. Look at what happens. We hit the overbought area right here that does not follow through above that high on a closing basis. So you do not take that as a new buy attempt. Same thing here. We have just about a week and a half ago, we saw this breakdown. And so from this perspective, you see that setup and attempted rally through the next morning does not close through there. We come right back down. So that's just the top of the trend. Whether using a 30-day time frame, looking back over the last 30 days or 6 weeks on the right panel, on the hourly, 30 bars works out to be about the last 4 trading days, because there's 7 hours, 7 bars really, 6.5 hours in every trading day. Of course, on a 24-hour chart on the E-mini, you're going to basically be looking back over just the last couple of days. But then you see also here that you're also looking at the 15-minute chart, typically at the last day and a half or so on most examples on a 15-minute 30-bar chart. So that 30-bar setting doesn't change from one time frame to the next. I've tested it across a lot of time frames, and 30 bars of the past action is the most consistent. Now, obviously, look at the hourly chart in the middle panel for a second, because you can see, look at the difference here over the last 30 bars of action in the middle panel. It's very classic trading range, isn't it? And you can see what's happening is at the low end of the range, it's not following through. When we go into that, where it gets colored into that blue territory, that's not getting any downside follow through. The prior one that had was when we had this little downtrend kicking in on the left side of that particular middle panel there. That was a little downtrend that was in place. Then when it violated, you can see that it ended up moving into this trading range mode. We hit the top of the trading range earlier today, early this morning and into this morning's open, and we couldn't follow through above that resistance right around the 14-15 area. And so, that inability to follow through is where you see, okay, that indeed you're not getting the top follow through of that. Now, the hourly chart was the only one on this particular 3 time frame setting that's not giving us an active sell yet. So I wouldn't say all systems are go just yet, but we're close. Right now, I show that the hourly setup is if we can close underneath that last hour low. I updated these charts right before we kicked off. That last hour low was 1403.50. Literally here in about 4 minutes, if we're at 1402.25 right now, if we close underneath 1403.50 here in about 4 minutes, even the hourly will go bear confirm. That can really open the floodgates, because now you have all 3 time frames on a sell signal if we close under 1403.50 here in 3 more minutes. So the idea of this is that all 3 rivers flowing to the downside, all 3 rivers flowing into one more powerful river, is the kind of concept that to me makes for a potentially very powerful signal. So we're about to go bearish on all 3 time frames, and that gives you even more confidence when you make these trades. Now, if I'm in on all 3 time frames, which one would I use to get out? I'm kind of picky. I like to use whichever one tells me to get out first, which is likely going to be the 15-minute chart. So the 15 minutes on a sell, and we'll look for the next retest point on that one. Right now, we've actually had a retest on it here. Sent those slides over at 1403.50. So 1403.50 is a very big number to watch on the E-mini chart. I'm not usually keyed on the E-mini, but I'm showing you that I can use this on any time frame that I want to trade. Now, a lot of questions will come about, okay, what kind of option would you want to use on this type of an example? Well, a good example, let's go back to Apple for just a second here, because if you're looking at Apple and you were looking, say, at the last, current trade that we had with the current retest, Apple gave a retest right back here on the current sell signal. On that 1-day bounce here about 4 days ago, it tested up to about 635. And it closed about 632. Now, if I've got, let's just use a round number. Let's say it closed at 630. I do not want to buy an at-the-money put if I'm bearish on Apple, because an at-the-money put holds the most time value. My first rule of thumb for you is a more conservative way to buy options is I like to buy options where I can at least get 2/3 intrinsic value and no more than 1/3 of time value. That's how to minimize my risk. And so from this perspective, we say, okay, then I would probably be looking at a 640 put with the stock trading about 632. That was 8 points in the money. That option was trading right about $11, going out about a week and a half, the weekly option. And so basically, that's a very reasonable risk-reward type of a ratio. Now, I'm running out of time here, but, one of the things that I wanted to share with you is how you can get all of my rules, basically for a song of a price point. For $97, this is a 5-hour event that I did, where basically you'll get 5 hours of content not just me speaking in front of an audience, but also a lot of chart examples that we'll zoom in on. And so we'll walk through even some things I didn't get time to cover. Not just the initial breakout strategy here, plus the specific rules of how you set up the retest. The retest, to me, is your lowest risk entry point. If you're concerned, like I am, about managing your risk in your trades precisely, the retest strategy for me gives me the best risk-reward ratio of any system and method I've tested over my 23 years of trading. So this is a way to kickstart yourself off, and you can see we've got the link up here, bigtrends.com/%R, just spelled out, percent with the letter R behind it. So bigtrends.com/%R, you'll go right into our shopping cart page where you can get this for $97, instant access on demand at that link. Now, the other ones I didn't have a chance to talk about include the bend but don't break strategy. What does this mean? It means that a lot of times you see a lot of key test points within a trend. If you get a pullback into a retest, a lot of times it may look like it's starting to break, and I've got a lot of students who are just starting to learn this method, and they may get flushed out of a trade if they react intra-bar. So I'll teach you how you can actually see where other traders are getting flushed out. The trend is bending, but by the end of the day, if it has a certain pattern where it doesn't break, these signals are actually especially powerful because that's the classic market flush out. It'll flush out the weak holders of a stock, and then it'll run the other way. Same thing on bearish trades. It'll flush them out with a little short covering rally, and then it'll have its true move to break down. And so we'll tell you all the trade management rules you need to know to follow this through across literally dozens of examples of trades, students asking questions and basically answering all the common Q&As that I get about the %R big trends way methodology. So this is a totally different way to use %R. You probably have it on your chart platform, but the bottom line is that this is your opportunity here to focus on a simple way to trade one indicator. If you're having any trouble with information overload, this is one line. It's one simple thing you got to follow, and it's available to be used across any given vehicle you want to trade, whether it's stocks, option charts, various Forex, ETF, and futures vehicles, you name it. The %R strategy, the Big Trends way, I think will open your eyes to a simpler way to trade, a less stressful way to trade, and frankly, it'll keep you out of a lot of choppy markets that you don't want to trade. It'll only allow you to focus on the best trends for any given time frame or multiple time frames. So, and Ali said, is that because the minimum sample size is 30 samples for a meaningful statistical analysis? There's probably something to that. I think it's also because we want to have enough time frame on the 30-bar setting to go back and see that we're indeed allowing ourselves to pick up these particular rules. One thing I caution you on is you may want to say, okay, well, you think you've got it all figured out and you can now start to implement this. If you don't get the training, I get concerned because I even folks that get the training, when they're first trying to explain it back to me in a follow-up coaching session, which we do for some traders, the bottom line is they still seem like they don't quite get it sometimes, especially on the retest method, the bend but don't break method. Those are your lower risk entry points, but you got to make sure you don't get flushed out. So make sure that you pick up the course there at bigtrends.com/%R. I think it'll really open your eyes, 5 hours of content. And again, I'm not going to go any further there. It's already a slam dunk at the $97. I want to thank you for being with us today. We've got a lot more speakers to come. So I'll hand it back over to Morgan, who can kind of segue us into the next speaker. If you have any questions, you can reach us at our 800 Big Trends number here too about the %R or anything else on the Big Trends way to trade. Thanks, and Morgan, take it away. Thanks so much.
All right, great. Thank you, Price. Again, we really appreciate you being here. Excellent session and a great way to kick off today's event. And again, you can learn more about that. It's bigtrends.com/%R. I put %4. Let me correct that real quick. It's www.bigtrends.com/%R. All right. So again, thanks to Price. We did record. The way we do our recording is just kind of an FYI. We separate each one out based on the speaker and then post them all on our website, so you guys will be able to view each session individually from that. We'll hopefully get them posted either later this afternoon or tomorrow morning. All right, Colin, at this time, I'll turn things over to you. In the next 30 minutes, the room is yours.